What Do We Do? A podcast discussing wealth management and financial planning, introducing listeners to the leaders in our community. Hosted by the founder and CEO of Great Lakes Wealth, Dewey Steffen, alongside WWJ Midday News anchor, Brooke Allen.
Hey, I'm Brooke Allen. Our goal with the What Do We Do podcast is to educate listeners on topics that impact your financial growth, your retirement, and your lifestyle.
And I'm Dewey Steffen. Join us twice a month as we welcome some of today's leaders in the community for conversations that can help with investment decisions so you can plan for and live your best life.
Here's Dewey Steffen alongside Brooke Allen.
Hey, I'm Brooke Allen. Thanks so much for being with us on the What Do We Do podcast. Of course, you want to like, subscribe, ring that bell, and share because you know what? We are here to help the community and also to kind of give advice when advice is needed. And what do we do? Dewey Steffen, it has been a tough start to the new year.
Happy, tough start to the year,
Yes,
Brooke.
thank you.
Good to see you.
You too.
This is episode 11 of season 2, number 53. Can you believe it?
I can't.
I can't believe it either. So excited, so blessed. We are proud to announce that we have over 25,000 downloads, views, listens. So thank you to our amazing community. We have information to share. We are leaders in our community. We try to be good corporate citizens. We want to share. And I think, again, to your point with what is going on to start 2022, we've got a job to do. And let's get to it with this podcast.
All right. Well, you know, honestly, we're seeing red in 2022. Is that true?
Yes, the month of January, at least through the first 3 weeks of January, have been nothing but red. And there's this word out there called correction. I mean, I know you like to correct me when I'm wrong, but this market has decided to correct itself with a correction. Are you familiar with this?
I'm not. So originally, I had thought, oh, a correction must be a good thing. And then I realized I was super wrong.
No, a correction is a good thing.
It is?
Yeah, when you want to buy a car and it's originally $30,000, but it goes on sale for $27,000, is that a good thing or a bad thing?
A good thing.
That's a good thing. If the market goes from $36,000 to $33,000 on the Dow, that's the same thing, down 10%. So isn't that a good thing?
No.
Heck yeah, it is. You want to buy low, sell high. Okay. Buy low, sell high. So corrections are a very important part of investing. Do you know what a correction is, by the way?
Tell me.
Correction is defined as a 10% or more drop in the markets, whatever market you're talking about. So the S&P through the first 3 weeks of January had a correction, down more than 10%. And the NASDAQ had a correction, down more than 10%. The next definition, Brooke, besides a correction, is called a bear market. Have you heard of a bear market?
I have.
So what do you think that means?
You know.
Okay.
You always stump me with these.
Well, again,
this is why you are the financial.
Fast fact.
Right?
Fast fact. A bear market is when the market that you're talking about drops 20%. So 10% is a correction.
Okay.
20% now we're talking, you've lost some serious cha-ching. If you have $1 million portfolio and you lose 10%, how much have you lost?
A lot.
A lot. You've answered that before. I like that as your answer, but maybe not enough.
Right.
But yeah, so 10% on $1 million is $100,000. So if you lose $100,000 in the market, you're down 10%. You might not be happy. But if you have other money to put into the market and it goes back up 10%, you've made how much on $1 million? If you put $1 million in and it goes up 10%, how much did you make?
A lot.
A lot. So you make 100,000, right? So again, if you're already all in, and this is the topic for today, is investing for 2022. What do we do in 2022? So investment plans and our playbook. So there's a lot of things we're going to talk about today, Brooke, but the overarching theme is volatility creates opportunity. And so if you're all in, you're just going to watch the volatility. But guess what? Do you know what the Dow was back in 1901?
I don't, but I know it's seen a huge increase.
Yeah, nor do I. I don't know. It was a little. It was a little back then. It wasn't even a lot. So again, historically, the stock markets have done exceptionally well over time. And along that way are corrections. There are bear markets. There are drops. So we want to talk about them and navigate through them successfully. So we're going to tell our audience today 11 tenets that we're going to use. And again, there is 10 is a nice, perfect number. No, it's not. Okay, at Great Lakes Wealth, we take the perfect 10, we add a bonus, call it a perfect 11,
right,
and we share it with our audience. So we have a perfect 11 tenets to not just survive, but thrive through the volatility that we'll see in 2022.
So so this is the investment playbook, correct?
Investment playbook, yes. And I'm going to start with another. So there'll be today is going to be a lot of definitions, a lot of quick sayings, cliches, that sort of thing, because it's really going to help our audience to navigate without it being too complex. We're going to dumb it down for today, if that's a way to express it. So anybody out there listening, anybody out there watching, please take some notes, write these things down or type them into your, your handheld device, and it should be able to trigger, action. Okay.
Right.
So another one I'll ask you, volatility. What does that mean, Brooke?
I would think up and down, right?
Fair
I mean,
enough.
you're just it's up and down. You don't know what's happening.
Yes, volatility is up and down, but in investing, we actually really think of it as just down. So when you're talking about investing, it was very volatile. It was up and down, but we always really refer to that as just the down part. So if the market is going to be volatile, we really mean the market's going to go down.
Okay.
Otherwise, we would say it's just going to go up. So volatility creates opportunity, and that actually means the down, buy it, it goes back up, you make it, goes down again, buy it, goes up again, make it, right?
It's kind of a game, right?
Well, no. So you can either stay in through it all and it goes up and down, but then it ends up higher. So it's an ascending line. Makes sense? Ascending.
Right.
So it depends on what period of time we're talking about. But again, we're going to talk about volatility, meaning drops, create opportunity, meaning rebounds, where you can cash out some cha-ching, cha-ching, or compound your growth for ultimate financial success long-term. Fair enough?
Fair enough.
Okay. So anyway, with that, let's just talk about these 11 tenets. Okay. And then we can kind of go through them one by one and what they mean or whatever. But they all are catchy, so that they are fun to talk about, but also easy to remember. Okay.
Right.
So the first one is don't catch a falling knife. How's that sound? Don't catch a falling knife. We'll come back through them and write them all down or listen to them all, but don't catch a falling knife. Don't fight the Fed. Deal with debt. Cash is trash.
You love that one.
Love that one. See the forest through the trees. DCA, dollar cost average. Don't keep all your eggs in one basket.
An all-time favorite.
Right? Rotate and rebalance. Buy the dips, sell the rips. That's a fun one. I like that one. Dividends matter. And our bonus, number 11, is yes, it's going to be hard in 2022. And the hard doesn't stand for difficult. Hard stands for hard assets. So part of our playbook is yes, it's going to be hard. And that'll mean investing in hard assets. So we'll talk about that also. That'll be the little bonus.
Okay.
Fair
Perfect.
enough? Okay.
Fair enough.
So, we want to start out the gate with don't catch a falling knife.
Okay.
What do you think that means?
Sounds like something I say to my kids, right?
That means don't take a knife out of the drawer and
Run with it?
Run with it, right? So when we talk about the markets, and this is what we've seen so far year to date, is the market be volatile, meaning drop and drop precipitously, fast, violent moves. So when the market is dropping fast, some say, I'm going to buy. I'm going to buy. It's dropping. It hasn't even stopped dropping, but I'm going to buy. So we use that phrase, don't catch a falling knife, because a market that goes down can actually go down more. You don't know where it's going to stop. We just talked about a correction is down 10%. Bear market is down 20%, right? Well, sometimes the market goes down 30%. It did in the month of March of 2020. Okay. It also went down almost 40% in the year of 2008. 2009, that was the Great Recession. And then it can go down 40% or more as well. Not very often, but it happens. So we always say, again, don't try to time it or when it's done. Don't catch a falling knife. Let it all settle out and then do your investing. Okay, so makes sense? I don't know.
It does. But
Okay.
I can tell you that I know it's dropped so far that people are freaking out.
Well, so again, volatility creates opportunity. So I don't know who's freaking out, but they should be doing a dance, doing the money dance. You want to buy low and sell high. So things have to move around, and so we're going to talk about them. But the first one, don't catch a falling knife, means don't rush to just buy because it started to go down. It can go down more. And if you're talking about an individual stock, there are bankruptcies that happen. They happened in 2008. So again, just don't be buying randomly in the middle of a cascading market that's dropping. Okay, so that's what that means. Slow down, get your plan together, but don't catch a falling knife. Number 2, don't fight the Fed. What do you think that means?
Oh, so many things, right? I mean, inflation is up. Interest rates are said to be going up, right? So you can't really fight the Fed, can you?
Well, so yes. So you can fight the Fed, which means when you invest, you need to invest along the same way as the Fed. So when the Fed is going to lower interest rates, we know that when rates are coming down, that will help expand opportunities. Low rates allows people to borrow at a better rate, and therefore they can invest and
Spend more, right?
well, they can spend more, spend that money for growth, right? So when that's happening, don't fight the Fed means invest for success. When the Fed is going to raise rates, that means they're going to try to slow things down. They're going to maybe deflate this bubble, if that's what it is. So all of that to say that when the Fed says they're going to raise rates, don't just take that with a grain of salt, because when they're lowering rates, there's one way to invest. When they're raising rates, that's another way to invest. And Brooke, I think you know this. What is the Fed's approach to interest rates for 2022?
They're going to raise it maybe 3 times, right?
Yes. So right now, the average estimate is 3 rate increases this year. Fast fact, it was 3.5 raises based upon the survey. But when the markets come down, then the Fed says, whoa, if I raise rates, I might even put more pressure on the market, which means make it go lower. So all of a sudden, dropping markets, the Fed may be less likely to raise rates. A rising market is when they may raise rates, because again, they're giving away and they need to take away and they need to give back. So don't fight the Fed. So this year, yes, please understand the Fed most likely will raise rates, whether it's 1 time, 2 times, 3 times, perhaps 4 times. And so make sure that you're investing knowing that that is going to happen. Okay, fair enough. Next one, deal with debt.
Pay your bills.
Pay your bills and get out of debt, because again, when interest rates are low, you can borrow more, and it doesn't cost as much.
Credit card, right?
Doesn't cost as much to pay it back. But when rates rise, so we just said on average the estimate is 3 rate increases for this year. That means an adjustable rate mortgage will adjust up. That means your credit card will adjust up. So any of their debt that's out there, you need to be more aggressively paying it off. If the rates are coming down, you don't have to pay off your debt. Let it ride. It's actually going to be a lower payment this month. Well, now your payments are going to go up and reset. So you need to deal with debt. Pay it off. We've talked many times on the What Do We Do podcast about good debt and bad debt. So make sure that you are servicing or restructuring or just eliminating your debt. Deal with debt.
Yes. That makes sense.
That's it.
Especially when you know that things are going to rise in cost.
Absolutely. And you mentioned it. inflation. So this goes to the next one, Brooke. I know you were laying me out a meatball, throwing it up there for me to whack it out of the park. Inflation is on the rise. So that means that cash is trash. Cash pays what? Close to nothing. You were going to say a lot. I was going to say you're crazy. Cash pays a little. Okay, maybe nothing if it's in your pocket. And it's devaluing because of inflation, right? The latest numbers of inflation are 7% year over year inflation. So you can argue you need to make 7% of your money to keep up with the cost of goods.
So just to stay even, right?
Just to stay even with what things are going up, you need to make 7% of your money. Can you do that in a bank? No. You might need to find some other solution, and that could be a stock over the long term. There are many other solutions. We've talked about them before. So again, cash is still, maybe we put the word in there, cash is still trash, because we've said that before, but this is a caveat. The Fed is going to raise rates, we believe. And as soon as maybe next month at the March meeting. If that happens, then guess what does go up? Your borrowing rates, so your credit card rates, your adjustable rates on what you borrow goes up, but also your money market rates and your savings account rates and any cash rates do go up also. So cash might go from 0.1 to 0.2.
Who knows?
That's a 100% increase. That's a double.
Right.
Booyah. No, that's a boo-hoo. Okay, so inflation is here to stay. We've said that before.
Yes.
We believe that. So interest rates are going to go up. Deal with debt. And then inflation is here. Cash is trash. Okay. Next one. See the forest through the trees. What the heck does that mean?
Anything that falls must go up. I don't know. What?
See the forest through the trees.
Being positive?
This is important for anyone out there talking about investments, but also anything else long term, whether it's your plan with your children, your plan for your company. So a tree is right in front of you, but it's a big forest out there. So don't get caught up on the one singular thing that's right in front of you. See the bigger picture.
Right.
See the forest through the trees. And in this case, in investing, it means that the tree is right now. The market is dropping, so I'm freaking out. Everyone is scared, as you said. The forest means it's going to go up long term. There's huge opportunities. Volatility creates opportunity. So see the forests, see that opportunity. Don't worry about this one tree that's right there in front of you. Got it?
Got it.
I love that one. See the forest through the trees. See the big picture.
Right. Awesome.
Opportunity. I'm going to go off script here and go, opportunity's knocking. Let it in. Okay. DCA. It sounds like LCA.
It does.
For those listening or watching around America, that's Little Caesars Arena here in Metro Detroit. But DCA does not stand for Dewey's Center Arena. Okay. DCA stands for dollar cost average. So dollar cost average means, any idea?
What the average dollar cost?
Okay, I love it. No. So the dollar cost average means, and we've talked about this in season 1, so go back to one of our prior podcasts and we'll get into the details on it and how you can strategy your DCA. But dollar cost average is actually what you do with your 401k or your 403b or any retirement account when you make repeatable, systematic payments. So when the market is volatile, going up and down, and you're just paying the same thing, $100, $200, some months you're buying more because you're just paying the same thing. So if something drops in price, you're buying a little bit more of it. If it's 2 things for 100 and you buy 2 of them, it's 200. Well, the next month I'm going to buy 2 more. Well, the prices drop so that you can buy, they're $50 instead of $100 or half. You can buy 4. If they go up to 200, you're only buying 1. So dollar cost average means buy a little bit at a time, repeatedly over a period of time. You can actually smooth out the ride and you actually get a better buying price. You don't have to time the market. You're just buying it over time. So, yeah.
So, okay, but when I said people were freaking out earlier, it was because, everyone immediately checks their 401k balances.
Yeah.
Right? Because you lose money when the stock market loses money.
Yeah.
So that's, I think, where the fear comes in sometimes for people because they don't want to believe that money's gone.
So I understand all that, and that's just why this is a very important podcast, because there is the difference between greed and fear. The market goes on extremes of greed and fear. And so when everything's in the 401k and it's going up every day, everyone's happy.
Right,
everyone's
for sure.
greedy. This is great. I made 10%. I made 15%. I made whatever I made, right? That's great. Well, you should also recognize, again, that volatility creates opportunity, or that there will be drops and there are corrections. And actually, people who have 401ks, I've found, and 403bs are less panicked than other investors, because they actually know that I'm adding to it. So even if I have an account with $100,000 in it and it drops 5%, which is $5,000, if I'm putting in $400 a month over a year, that's $4,800. Basically 5,000. So even though the market's taking your account down 5% and you would only have 95,000, you actually put in 4,800. So you're like, hey, I actually didn't even lose. Well, technically you did, because you put in, now you have 105 in. Well, guess what? It goes back up that 5%. And so now your 100 is back to 100, but that 4,800 now has, 5% growth on it, $240 or whatever that is. So you actually see less of a volatile movement when you are doing a DCA. And a DCA strategy, you can do it over a month. If you need to get your money in the market, well, don't do it just tomorrow. Put it over the 20 trading days of the month, Monday through Friday. Divide it up. Most people don't do that. They would do a DCA, or a dollar cost average, over a 3-month period, over a 6-month period, or over a year period. So again, a very simple strategy of investing is dollar cost average, DCA. Check it out. Our prior podcast for more details. Very important.
Hey guys, it's Brooke. I want to take a minute to talk to you about Dewey Stephan and his great team at Great Lakes Wealth. Do you feel overwhelmed managing your assets? Well, Great Lakes Wealth offers Wall Street solutions with Main Street values. That is really what they are all about. They will help you develop a custom financial plan utilizing all of your assets and keeping your goals in mind. That is what Great Lakes Wealth is all about, helping you and your family achieve your financial dreams. So go to greatlakeswealth.us to schedule an appointment today and tell them Brooke sent you.
Next one. Love this one. Don't keep all your eggs in one basket. What the heck does that mean?
I'm giving you $1 and I'm telling you to keep it in one spot.
So don't keep all your eggs in one basket. Means if you have a bunch of eggs and you put them in one basket and that basket drops because one of the Twinkies wasn't holding it, or one of the Steffens wasn't holding it right, and it drops, all those eggs smash.
Right.
You have no eggs.
Right.
Hopefully you can put them in a pan and make an omelet. That's all you got.
Right.
But if you have 10 baskets and one egg in each basket, and only one of those eggs drops, or baskets drops, then you still have 9 eggs. So that's called diversification. So again, if you have all your money in the stock market and the market drops 10%, you lose 10%. The stock market drops 20% and you have all your eggs in the market, how much do you lose?
20%.
20%. Well, guess what? As we say with diversification, when one thing goes up, another thing goes down. There are times that everything goes down, but they don't even go down at the same rate. U.S. treasuries or bonds typically go down less than stocks. They also go up less than stocks typically as well. But if you have diversification, we're going to talk about other things later, like gold, silver. We call these things precious metals.
Yes.
We also have cryptocurrency, digital gold. We also have real estate. We have a lot of other investments that are called alternatives. And so they're alternative. They're diversified. They have different rate and return profiles than the stock market. So if you have DCA last time, you're buying a lot of different times, you smooth out the ride. If you have not all your eggs in one basket, you again will be smoothing out the ride. Now, if the stock market doesn't drop, but gold drops, and you have all your eggs in stocks, you're fine, because it didn't affect you.
Right.
If you have all your eggs in gold because you said, hey, I'm going to be safe because Dewey's going to talk about how hard the market is, meaning hard assets, so I'm going to put it all in gold because I know that's a hedge against inflation. Well, gold can go down on its own because of other factors, so you just don't put everything into one thing.
Makes sense.
Makes sense. Put it in your own house, 2007 and 8 and 9. How'd that help you? Okay. So again, don't keep all your eggs in one basket. Means diversify, diversify, diversify. Nice.
Nice.
I like
I learned
this
so
one.
much from you.
Well, again, we do this all day long. We're happy to share. These are very important tenets
They are.
for 2022. The next one, rotate and rebalance. What do you think about that?
Well, I think it's kind of similar to what you just said, right?
I think I got a car with a flat tire, so I'm going to rotate it and then rebalance. Oh no, that'd be a change it and balance it or something. I'm just kind of kidding. No, rotate and rebalance means yes, you need to see where you're at, and when the facts change your mind. So last year, it might have been a Fed that was accommodative, meaning lowering rates or keeping things available. And now they're not going to be so accommodative. And so when the story changes, we also need to change our investing strategy. Higher interest rates, higher inflation, different strategy than lower interest rates, lower inflation. We also have a different outlook on the business cycle. The business cycle has 4 parts to it, and we're going into what we think is late stage business cycle, and the next one is recession. So again, every business cycle, right, has its early, its mid, its late, and then recession. It goes up and down. And so with that, you also need to understand that there's a difference between investing in technology, different investing in healthcare, different investing in materials, industrials. There are 11 sectors of the S&P. We talked about that in season 1 also, to where rotate and rebalance means you need to move into what's coming, not into what was working last year, and get your percentages right. Another part of don't keep all your eggs in one basket is you need to be diversified based upon your own particular situation. So the number of baskets you need isn't just a number for all of us. Your number of baskets is different than my number of baskets. But rotate and rebalance means to make sure you're looking ahead, not behind. You know what? The great Wayne Gretzky, do you know who he is?
Yes, of course.
Wayne Gretzky used to say, I skate to where the puck is going to be, not to where it is. And so again, we want to be forecasting and moving towards parts of the market that we think do well in a late cycle economy. And we'll talk about that maybe in another podcast.
Okay, so I had a question for you. How many people actively do this like all the time? I mean, it's what you do. But for me, I may not pay attention to what's really going on. I just know the numbers are down, what's happening. Do you know what I mean? Like the average person, do they sit there at their computer and try to reallocate everything to make it work, or do they just ride it out?
So all of these things are not to be done daily. So you don't put all your eggs in different baskets daily. You don't DCA over a day. Again, we talked about. So all of them can be done, but it's the same thing. Hire a professional. Right. Reach out to us at Great Lakes Wealth or your financial advisor or team, and again, come up with your strategy. But everyone should be doing all of this, whether it's, again, in your household with your health. You should be, doing some push-ups or some sit-ups. You also should be eating, well, and not staying out late, get your sleep. So there are probably 11 tenets. Hey, Brooke, let's do that later. 11 tenets of health. Right, healthy, wealthy, and wise,
exactly,
right? So with that, yes. So I don't know what people do when they do their own thing. But again, if you don't do it right, do it well, I guess. And these hopefully help. So some of it you can take care of on your own, your 401k, your 403b, that happens. But a lot of these, again, you need to see a professional or use this podcast as your guide for investment success in 2022.
It seems like at this point right now, you need it. You need help.
You always need help. Every year is a new year, again, but a lot of it is just what do we do? There's a good plug for the podcast. Right. What do we do this year is different than what did we do last year. Some things are always universal. It's, what I think we're going to make it the next one. How about this? It's not timing the market. It's time in the market. So have you heard that one? Right. So that's one is the easiest of all. It's not trying to get in and get out and get in and get out. Just be in it. Right. And drops happen. There's an old one we used to say, don't open your mail. When the market's down, don't open your mail. You won't see your statement. You don't know. But now everything's digital. It's on your phone. Every 5 seconds you can see what your account is up. But back in the day, investors, it tells you my age, would just seriously not open their mail because then they wouldn't see it. They wouldn't really know because it'll go back up. It will be fine. So, again, these are very important ideas to discuss. But rotate and rebalance is definitely something that you need to understand and be proactive about in 2022.
Okay.
Okay?
Yes.
Fair enough.
Yes.
Another one. I love this one because this is actually for traders. So I'm going to give a little trader love out there for you shorter term investors or ones that want to kind of take advantage of these swings because they will be violent, which is a good thing. Buy the dips, sell the rips. What does that mean?
I don't know.
Okay. Well, again, besides a correction and a bear market is just a drop. So a drop can be a dip. Mm-hmm. When the market dips, I buy a little bit. When the market rips, I sell a bit, meaning when the market has a pop or a drop. There's another one you can say that. Market drops, market pops. Mm-hmm. So in this case, buy the dips, sell the rips. So when the market does drop and you think it's going to go back up because it's a volatile year but still ascending, so then you're what's known as a dip buyer. I buy the dips. You can let it go long term, or you can be I'm going to sell the rip seller. So I'm trying to just make some short-term buys and sells and profit in between. So we don't recommend that as your lifelong strategy. Just you can buy dips forever, part of maybe DCA 201 class, but otherwise just buy the dips. And if you see a pop back up and you make something more than you think you should have, then sell. There's a freebie. It's not on our list today, but bulls make money, bears make money, pigs get slaughtered. Have you heard this one?
I have not.
Holy moly, it just came in my head. So bears mean if all goes down, you can actually short the market for a while, make some money through a transition like we're going through now. But you can also make a lot of money in a bull market. So bear markets go down. You can bet on that and make some money. Markets going up, bull markets, you can make money. But if things go up and then you don't sell, eventually they're going to come back down and you're being greedy. You're a pig. Pigs get slaughtered. So that's where, listen, just, be thoughtful with your investing. That's not one of our 11 tenants. That's just a little something from
little
me
side
to you.
note.
Little side note. Absolutely. And go with another one of those. Bird in the hand, two in the bush. It's not on our list either, but same thing. Bird in the hand, two in the bush. I don't even know what that means. I said that in season 1, but that means something like, listen, if you've got it in front of you, if you don't take advantage of it and cash a little bit in, then again, you're being greedy and you deserve to, have something bad happen just because of fate.
Right.
I think that's just how it goes. Next one. Okay, we're getting into the final two. Dividends matter for 2022. What does that mean?
Tell me.
Okay. Well, dividends might matter all the time, but there's a group of stocks out there called dividend-paying stocks, and that means that they pay out dividends or income to their investors. So if you buy a stock in Coca-Cola or you buy a stock in any blue chip company and pays a dividend, then you own the stock. Hopefully it goes up and appreciates, but even if it doesn't, they pay a dividend. So you make some money while it's doing whatever else it's doing. Some people use it to live off of. We've talked about this in a prior podcast about income investing versus growth investing. So check that one out. But in this case, where dividends matter, in a situation of a volatile market, then again, a stock that pays a dividend will smooth out your ride. Current dividend in the S&P is around 2%. So guess what? As long as you can do it the ride, you can get 2% a year on your S&P investment versus the bank at 0.2. So in a world where the Fed's going to raise rates, there's these other things called there's these other things that happen in a market that is going to adjust because the Federal Reserve is raising rates. And a lot of it has to do with companies that don't have cash flow or that are borrowing more and growing more. They have top line growth, but not bottom line results. And those are the stocks that tend to not pay dividends. And they tend to be the ones that go up the most in a great market. They go down the most in a challenging market. So if it was a market that we thought was robust and the Fed was going to be accommodative, we might say dividends don't matter, go for the growth. Maybe that will say that in the future. Instead of going for the gold, go for the growth. But in this case, we recommend you do not invest in growthy, speculative companies. Go find investments and stocks that pay dividends, cash flow, dividends matter. Does that make sense?
Yeah.
Okay,
Completely.
awesome. Good. Well, and I think that's 10. Count it. 1, 2, 3, 4, 5, 6, 7, 8,
There were
9,
a couple
10.
bonuses in there, but okay.
Yes, you got 10 plus. And then again, so I think that's 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. But the 11th is in 2022, it will be hard. It will be hard. And I'm not talking about investing because we know that's always hard,
Right.
but hard assets. Hard assets. A, because they are not correlated to the stock market directly. You know what correlation means?
Tell me.
Correlation means how they're related to. So they beat to their own drummer. A stock can go up and down, and some other things are inversely correlated, which means if a stock goes down, maybe a bond goes up. Things have different correlations of how they go. In a flash crash panic, everything correlates to one, meaning they all go down. In a euphoric, it's all good in the hood type of market, then everything goes up, correlates to one. But most investment cycles or years or periods, back to that don't keep all your eggs in one basket tenant, things go up when other things go down, things go sideways, and they have nothing to do with other things. Well, in a year where there is going to be inflation that stays, there is going to be a Fed that is not accommodative, there is a situation where the U.S. dollar may actually weaken this year as well. It's a period where hard assets, which we've also talked about in a prior podcast, which could be commodities, it could be gold, silver, and other precious metals. It actually could be digital assets or digital gold, Bitcoin, Ethereum, whatever the case is. We've talked about these in prior pods as well. Real estate is considered a hard asset as well, because guess what? Even if your house goes up and down in price, if you have a tenant in there paying you rent, as long as they're paying, then you actually don't really care if the state equalized value, if the SEV of the property, or on Zillow, if it's up or down. You really don't care as long as you're getting that rent
your money,
check
right?
that you were
Exactly.
expecting.
Right.
So these are things that will help in a volatile market. So you just don't survive, but thrive. Perfect, right?
We got this.
Okay, so there's the 11.
Right.
I'll go through them one more time real fast. Don't catch a falling knife. Don't fight the Fed. Deal with debt. Cash is trash. See the forest through the trees. Dollar cost average. Don't keep all your eggs in one basket. Rotate and rebalance. Buy the dips. Sell the rips. Dividends matter. And it should be hard in 2022. I love it.
Got it.
Easy peasy.
Easy peasy.
Okay. Well, last, before we wrap up, I guess would be the bottom line for 2022 is also don't panic, be patient, and execute your plan. The 3 Ps. Patient, don't panic, execute your plan.
Steady.
Volatility creates opportunity. I don't know about steady Eddie, but we'll give it a go. I think that's about out of time.
Okay. Well, hey, it's great. I always learn so much from you, honestly.
Well, thanks everyone out there for watching and listening. Hopefully it wasn't too much information. We're excited to be here helping our community. Back to the roll up the sleeves, if you will, and get into it with 2022. As we always say, Brooke, this is episode 11, season 2, number 53. And we're just getting started. Booyah.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.